The stock market is currently closed, and the final regular trading session for NVDA stock ended on Thursday, July 16, 2026, at 4 p.m. Eastern Standard Time, with the share price sitting at exactly $207.40. This price reflects a noticeable downward push during the day, dropping by $5.10, which translates to a 2.4% decline from the prior close. While most market commentators are busy talking about temporary tech sector pullbacks, the hidden reality under the surface is much more complicated. Institutional data shows that large funds are quietly setting up massive options blocks to hedge against a structural shift in how cloud providers buy hardware, a move that could disrupt the hardware pricing model over the next 12 months. When you look at popular online platforms today, the common belief among most retail investors is that this company is a permanent engine of growth that can never be stopped. People opening up a retail account for self-investing or browsing through popular investing sites see a business that dominates more than 80% of the advanced chip market and assume the equity will inevitably march back toward its all-time highs. It is the dominant talking point across online investment communities. But if you peer past that optimism, a contrarian perspective is emerging among major wealth management desks. The hyper-growth phase driven by pure infrastructure supply shortages is winding down, and we are entering a phase where the customers themselves are starting to build their own hardware alternatives, meaning the absolute pricing power this firm enjoyed is facing its first real test. If you track the daily swings over the past few weeks, the volatility tells a fascinating story. Trading volume has spiked well above its 3-month average, hovering near 123 million shares during the last session. This volume surge during a downward price move usually signals institutional distribution rather than simple retail profit-taking. We are seeing a broader rotation out of high-flying technology names, affecting not just this ticker, but also putting pressure on Tesla stock and Apple stock as large fund managers rebalance their heavy growth allocations. Many investors managing an individual brokerage account or using automated platforms like Schwab Intelligent Portfolios are noticing their portfolios shifting capital out of mega-cap tech and into defensive sectors or small-cap value equities. This sector momentum shift is putting severe technical pressure on the chip giant, forcing it to test key moving averages that have held as solid support for the past year. Macroeconomic pressures are also playing a major role in this recent downward momentum. With sticky inflation indicators and persistent interest rate uncertainties weighing on the broader market, institutional buyers are demanding higher risk premiums. If you look at options flow on the Interactive Brokers trading platform or look through analytics on the Fidelity trading platform, there has been a significant rise in deep out-of-the-money put options expiring over the next quarter. This indicates that professional traders are paying high premiums to protect their downside. Meanwhile, everyday retail buyers log on to the Robinhood app or execute trades via SoFi Active Investing to buy what they perceive as a cheap discount. This creates a fascinating tug-of-war where institutional capital is distributing shares while retail accounts are absorbing them, a pattern that historically precedes extended periods of price consolidation or further corrections. To understand the core underlying tension, we need to look at what the business actually does and how its fundamental business model operates. At its heart, the company designs advanced graphic processing units and compiles the critical software architecture known as CUDA that binds developers to its ecosystem. For years, this combination created an incredibly wide economic moat. Past earnings reports show massive net profit margins exceeding 60%, an almost unheard-of level of profitability for a hardware assembler. But that spectacular past performance was achieved during a unique window when every major corporation was scrambling to purchase processors at any price to avoid falling behind. Now that these systems are installed, the narrative is shifting from building infrastructure to generating actual returns on that hardware investment. If these massive corporations cannot prove to the public that their new systems are generating clear profits, their capital expenditures will drop sharply, directly hitting the chip designers' future order books. For anyone trying to navigate these changes without professional investment help, looking at the tools available across different platforms can reveal a lot about market sentiment. On the Robinhood stock trading dashboard, this asset remains one of the most widely held positions, and the platform's features for fractional shares have allowed small buyers to constantly add to their holdings during dips. Similarly, users utilizing a SoFi robo-advisor or building out a custom portfolio through Fidelity Investments have kept a steady stream of capital flowing into diversified semiconductor exchange-traded funds. But the sophisticated trading data accessible on the Interactive Brokers trading platform shows that short interest has crept up slightly over the summer months. Professional short sellers are betting that the upcoming quarterly earnings release will show a flattening margin profile, which could cause a sudden re-rating of the stock's valuation multiple. Let us shift our focus toward the future outlook and map out the realistic scenarios that could unfold over the next few quarters. The central catalyst everyone is watching is the supply chain stability for the next generation of computing architectures. If production lines run smoothly and customer demand remains insatiable, the stock could easily find its footing and mount a sustained rally back toward the $230 range. On the other hand, if hyperscale cloud customers decide to stretch the life cycle of their current processors or accelerate the deployment of their internal custom silicon designs, the revenue drop-off could be sharp. If that reality falls short of the massive expectations built into the current valuation, the stock could easily break below its recent support levels and drift down to test the $180 range, forcing a painful adjustment for growth-focused portfolios. Comment below how many shares of NVDA stock you currently hold in your portfolio right now and whether you are buying more or cutting back. When you evaluate the whole picture, the gap between investor expectation and underlying market reality is wider than it has been in a long time. The public narrative says this is a risk-free bet on the future of global computing power, but the structural reality of institutional distribution, rising short interest, and customer diversification paints a far more cautious picture. Whether you manage your capital through comprehensive Fidelity wealth management accounts, utilize specialized Fidelity IRAs for long-term growth, or run a highly active individual strategy using the Robinhood cash management features, recognizing this tension is vital. Success in online investing doesn't come from blindly following popular consensus, it comes from tracking where the actual capital is moving. By watching institutional flow, evaluating chip production metrics, and keeping an eye on sector rotation, you can protect your wealth and make decisions based on data rather than broad market hype. For individual traders using a basic Fidelity brokerage account or browsing options through the SoFi trading platform, the key is to avoid emotional decisions during these sharp intraday swings. The market has a unique way of penalizing maximum optimism, and right now the high valuation requires near-flawless execution from management. If you're executing trades through a mobile app or adjusting your long-term allocations in an intelligent portfolio, it's essential to balance your technology exposure with diversified assets like broad market Fidelity mutual funds or stable Fidelity ETFs. The tools built into modern platforms, from the comprehensive Interactive Brokers fee structure designed for high-volume traders to the simplified interfaces for Robinhood Investments, make it easier than ever to manage risk. Ultimately, the company remains a dominant player, but the current market environment demands a disciplined approach that respects the real structural headwinds facing the tech sector today. As you look forward, pay close attention to the capital expenditure guidance provided by the top cloud platform operators during the next earnings cycle. Their corporate spending plans will tell you exactly how much runway this chip supplier has left before demand stabilizes. If their budgets expand, it will provide a massive lift to the entire semiconductor sector. If they signal a deceleration, the premium multiples currently assigned to these tech leaders will look increasingly difficult to defend. Keep your strategy grounded in these fundamental corporate realities, stay updated on institutional trading volumes across the major investing sites, and ensure your individual strategy is built to handle the inherent volatility of the modern market landscape. Disclaimer: This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any financial investment decisions. Invest responsibly.